You're listening to The Capital Table. Private capital markets have been evolving for many years, but never more so than in recent times. Take a seat at the Capital Table with leading experts discussing insights into the private equity and M&A worlds, and take away the knowledge you need to excel in a rapidly changing marketplace. We know this is one table you'll leave feeling full and satisfied.
Hello, everybody. Thanks for joining the Capital Table again. We're really looking forward to talking with our good friend Bruce Frenton with Troutman Pepper Locke as we discuss structuring for uncertainty, legal trends and middle market M&A, a lot going on with all the uncertainty. So this will be part one of a two-part series, and we really look forward to discussing that with Bruce.
Steve, thanks for having me. Great to be here.
Yeah, it should be a great discussion to our audience as we talk about, legal trends and what's going on in middle market M&A. Bruce, so let's start off with that uncertainty. Certainly, I think we're all seeing that deals are more complicated to get to the finish line today. Your thoughts on that?
Yeah, I think that's right. Deal lawyers will either tell you deals are always complicated and that's why you need deal lawyers, or the same thing the opposite way. With deal lawyers, everything's smooth and we have a clear path to closing. But kidding aside, things have gotten more complicated recently, because of, among other things, the political issues, some of the global hotspots, and in particular for not only U.S. but international deal making, the so-called Liberation Day tariffs have created massive uncertainty in the M&A market. A quick example, it's hard to know how much to pay for a business if you don't know what your tariff exposure is going to be in a tariff-exposed business.
Yeah, no, absolutely. And I think, what we're saying, it's interesting as we closed out 2025, and the continuation of over $2 trillion worth of undeployed capital in private equity, the impetus to get deals done, it's been there for a couple of years now, but it just continues to get stronger. But to your point on tariffs, I think, the other interesting thing, and ties into our topic, is even in the industrial space, people are trying to get deals done. And, sellers are at the point they need to sell, hopefully bridging the valuation gaps in their mind a little bit. But again, at the end of the day, I think structuring needs to get us there. So, those are great points you bring up, Bruce. And I think maybe one other topic on the uncertainty to get your thoughts on is just, what's happened in the credit market. Interest rates are, I'll call them real again. We've both been around long enough to remember when interest rates were crazy, but right now is something that's more of a normal versus the decade or so prior where we had a lot of free money.
I remember, you have to be of a particular generation where either you remember in particular or you remember your parents telling you about when their home mortgage rates were 17 or 18%. And of course, at the time, gas was 25 cents a gallon. So, figure, and they were upset because it used to be cheaper. In any event, agree. Interest rates are a real interest rate, despite the recent action by the Fed to lower interest rates again. The real question, besides the one that you very properly raised, which is, does it create complexity in the deal world currently for people who have not had a lot of reason to have to factor a significant interest rate into their modeling to suddenly have to do that? And the answer, of course, is absolutely, it does. But also the other question that comes up is, where is the money coming from, and how easy is it to get that debt capital? And the other trend that you and I have talked about before, so I know you're well aware of and tracking, is really the growth of private debt, private capital, the fund a lender greatly to this point, supplanting traditional commercial lenders as the a or the principal source of debt capital for private equity M&A transactions. And of course, the impetus, the trigger for that was the fall of Silicon Valley Bank and the government's reaction to that in using its governance authority to push commercial lenders to strengthen their balance sheets. Strengthening your balance sheet in this context is a euphemism for kind of cutting back on so-called risky loans. And of course, the definition of risky is in the eye of the beholder. So when the government comes and tells you to clean up your balance sheet, you very substantially pull back or pull out of the lending market. So not only is money more expensive than it was, say, 5-10 years ago, there's less of it available, and of course, scarcity drives prices up as well.
Yeah, absolutely. And certainly we're seeing that across the board, and the emergence of private credit more and more so as we see deals. So, as we look forward, and again, a lot of macro factors are converging that, I think we're all in the deal world seeing positive trends for activity to increase as we go forward the next several quarters. But with the lack of free money, with valuation gaps, with tariff issues and other risks that are always there in a deal, let's shift to talking about, what are some of those structuring mechanisms that, help to bridge that gap or shift risk or share risk. Who always talks, RWI and indemnities. What are you seeing going on in those two categories today?
Yeah, so firstly, just kind of a shout out to the middle market in general and middle market practitioners. I find that despite, to your point, Steve, despite all of the challenges and a lot of what you were saying earlier is a continuing trend. There's been a ton of private equity overhang money for a very long time. There have been a ton of kind of pent up demand, as they say. There are one of the reasons continuation vehicles are so popular is because private equity has delayed exiting certain transactions with certain portfolio companies and needs continuation vehicles in order to get fresh capital, in order to keep things going. But despite all that and throughout all that, the middle market is flexible. The middle market is robust. The middle market's intuitive, and it's deal professionals as much as the private equity and investment banker participants are. So deals are getting done, but as you say, they're getting done with more structure and more hedging. And the first element of that risk sharing or risk mitigation, as you pointed out, is the wonderful insurance instrument, representation and warranty insurance. And initially really only a device used by private equity, not by strategics. It has become fairly universally utilized under the right circumstances, not only because of the direct economic risk mitigation, but it also has some other less directly economic benefits, such as there was always an inherent risk in or an inherent conflict in a buyer getting indemnity from the person running their business going forward. It's in a strategic sale, and this is interesting because it kind of helps explain some of what we were just talking about. But in a strategic sale, the buyer tends to sell out 100%. So the risk of annoying your seller drops precipitously when your seller gets a check and it goes home, moves to the Bahamas, does whatever sellers do with their money. If there's a rep and warranty breach, the buyer makes claim against the seller. But in private equity, when a private equity buyer buys a new portfolio company and has the seller, the former founder, run the business for the private equity group, if you're making an indemnity claim, you're literally taking the key individual and demanding money from that person. And the rep and warranty insurance product greatly eliminates that tension and greatly eliminates that relationship risk, which is another reason why, in addition to the economics of simply paying a one-time premium, and then all of the claims are against the seller. I'm sorry, the insurance company, as opposed to the seller. I mean, that really kind of creates a much more open path for the buyer and the seller to work together going forward.
That's a really, really fascinating point on the relationship risk, and certainly, a great insight for our audience into just that important dynamic of a private equity deal. So, well thought out. Bruce, great start to the discussion on structuring for uncertainty. Really appreciate you joining us for this first part of a two-part discussion on structuring for uncertainty and all the legal trends going on in middle market M&A. Thanks for joining us, and look forward to talking to you again soon.
Thanks for having me, Steve. Look forward to the second part of our conversation.
You've been listening to The Capital Table. For more information, please visit withum.com. Thank you for listening.